Most investors are told speculation is gambling. Never do it. But here's the thing. That's only half the truth. Because when used correctly, a little bit of speculation can actually make you a smarter investor, not a reckless one. It can teach you discipline, keep you curious, and sometimes even help you catch the next wave of innovation before the crowd sees it. So today, we're diving into this positive side of speculation, when it makes sense, how to do it safely, and how it fits inside your compounding strategy. Stick around, because by the end, you'll know exactly how to speculate without losing your shirt. Hello, fellow compounders. I'm Dennis Chen, CFA charter holder, former hedge fund manager, and chief compounder here at the Always Be Compounding Club. Here, we focus on building wealth that lasts through clarity, patience, and long-term compounding. Before we continue, a quick disclaimer. This video is for educational and entertainment purposes only. It is not financial, investment, or tax advice. All tickers and examples are hypothetical and for illustration only. I'm sharing general information and examples, not recommendations tailored to you. Investing involves risk, including possible loss of principal. Past performance does not guarantee future results. Your situation is unique. Always do your own research and consult a qualified financial professional before making any decisions. All right. Let's start by redefining speculation. Part 1. What makes speculation right or wrong? Speculation gets a bad name, and let's be honest, it deserves it sometimes. People chase meme stocks, gamble on crypto, or trade options like it's Vegas. But here's the nuance most people miss. Speculation isn't evil. It's simply higher risk investing. The difference is awareness. If you know you're speculating and you keep it controlled, it's intelligent. If you don't realize you're speculating and think you're investing, that's when you get hurt. It's not speculation that ruins portfolios, it's confusion. So, how do you know which side of the line you're on? Investor or speculator? Let's make it crystal clear. Part 2. The real difference between investing and speculating. Speculation means buying something that might produce value later, but hasn't proven it yet. Benjamin Graham, Warren Buffett's mentor, put it perfectly. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. If your return depends on predictable cash flow, you're investing. If it depends on the future working out as you hope, you're speculating. But here's the twist. Speculation isn't always a bad thing. In fact, sometimes it's how investors fund the future. Part 3. Speculating on innovation. The productive kind of speculation. Think about innovation. AI, biotech, clean energy, quantum computing. Buying Apple or Microsoft today is investing. They're already profitable. But buying a pre-profit AI startup or biotech firm still in trials, that's speculation. You're betting that the technology will work, the market will adopt it, the company will execute successfully. All those are unknowns. That makes it speculative, but not stupid. You're taking an educated risk, backing innovation that might reshape the world. Investing is buying what is. Speculating is buying what could be. So, how do we separate smart speculation from blind gambling? Let's look at a few examples side by side. Part 4. Why emerging tech is speculative, even if you expect future profits. Here's a common question I get. If I expect a company to make profits later, isn't that investing? Not necessarily. Expecting profits isn't the same as earning them. Let's compare two companies side by side. One represents investing and the other represents speculation on innovation. First, Apple. It earns billions of dollars, pays dividends, and generates steady cash flow year after year. That's a proven business, so you're investing in real performance. Now compare that to Quantum Chip Labs, a promising quantum computing startup. No revenue yet, no profits, but big potential. You're not investing in what is, you're speculating on what could be. Here's how they line up. Apple, yes, current profits, valued on actual earnings, and that's true investing. Quantum Chip Labs, no profits yet, valued purely on future potential, which makes it speculation. Same logic, different stage of uncertainty. Both can be smart, but only one is proven today. Speculating on innovation is like planting seeds. Some will sprout, others won't. And if that's the case, what about assets that never produce anything, like Bitcoin? Let's talk about that. Part 5. Why Bitcoin is pure speculation. Bitcoin doesn't make or sell anything. It has no profits, no employees, no products, just belief. You probably heard me talk about this before. Its price depends entirely on what someone else is willing to pay. Some people would call it the greater fool's theory. That's not a business. That's a trading instrument. So, while emerging tech speculation is tied to execution risk, Bitcoin is tied to sentiment risk. Emerging tech might one day earn profits. Bitcoin never will. That's pure speculation, a bet on perception, not productivity. So, where does all this fit in our portfolio? Let's zoom out and take a look at the full spectrum. Part 6, the speculation spectrum. Now, instead of thinking of speculation and investing as opposites, picture them as a spectrum. Think of investing and speculation as a gradient, not black and white. On one side, you have guaranteed income. That's pure investing. On the other side, you have assets with no intrinsic value. That's pure speculation. Everything else sits somewhere in between. At the safest end, you have treasury bonds, guaranteed returns backed by the government. Next, dividend stocks, reliable profits and income. Then growth stocks, still profitable, but more volatile. And as we move up the risk curve, we hit emerging tech, exciting but unproven. Then startups, high uncertainty, binary outcomes. And finally, Bitcoins and NFTs. No earnings, just sentiments. That's pure speculation. The goal isn't to avoid everything on the right. It's to know how much you own of it and why. Every asset falls somewhere on this line. The trick is knowing where you are and how much of your wealth sits on the speculative end. So, how do we use speculation intelligently without letting it hijack our compounding plan? Part 7. The speculative satellite portfolio. Inside the Always Be Compounding framework, speculation has a home, a small intentional one. It belongs in your speculative satellite portfolio. Think of it as your sandbox for exploration, small, contained, and designed to complement your long-term compounding core. Here's what it looks like in practice. Your core portfolio makes up about 85 to 90% of your total wealth. That's your compounding engine. Things like index funds, dividend growers, and real estate. Then comes your speculative satellite portfolio. A small slice, maybe 5 to 10%. That's reserved for higher risk, higher upside ideas. Things like emerging technologies, venture-style investments, or early innovation funds. The rule is simple. If every speculative bet goes to zero, your life doesn't change. But if one succeeds, it accelerates your journey without ever putting your foundation at risk. That's smart speculation, aligned with compounding, not against it. Now that you know where speculation belongs, how do you actually do it responsibly? Part 8, the 5 rules for smart speculation. All right, now that we know where speculation belongs, let's talk about how to do it intelligently. Here are my 5 rules for smart speculation. 1. Build your core. Earn the right to speculate only after your foundation is secure. You have an emergency fund, diversified holdings, and a written plan. 2. Cap it at 5 to 10%. Your curiosity capital, if it doubles, fantastic. If it goes to zero, no big deal. 3. Have a clear thesis. If you can't explain the why in one paragraph, you don't understand the risk. So don't do it. 4. Define exit rules. Know when to take profits or cut losses before you buy. That's how you stay rational when emotions kick in. 5. Reflect and learn. Every speculation, win or lose, should teach you something. Treat each one as tuition in the school of investing. Follow these 5 rules and speculation stops being dangerous. It becomes disciplined experimentation. Part 9. Intelligent speculation in practice. Let's make this concrete. Here are 3 examples of intelligent speculation that fit perfectly inside your speculative satellite portfolio. First, early innovation funds. You're getting diversified exposure to themes like AI or clean energy, but spreading the risk across dozens of companies. Second, selective single company bets. A small stake in a promising company, maybe a new medical device or semiconductor innovator. Small enough to lose, big enough to matter. And third, controlled venture exposure. Participating through a small angel syndicate or venture fund, but capped at a tiny percentage of your total assets. These aren't YOLO trades. They're structured experiments with clear upside and defined risk. Each of these examples lets you engage with innovation without betting the farm. So how do you keep that excitement balanced and disciplined? Part 10. Balancing excitement with discipline. Speculation should feel exciting, but should never feel urgent. If you're losing sleep, you're doing it wrong. Your goal isn't to predict the next Tesla. is to participate in innovation without derailing compounding. Think of your core as a tree trunk, stable, strong, compounding. Your speculative satellite is the branch, reaching out for sunlight, growing faster, but able to bend without breaking. And if you want to see exactly how to design that balance in your portfolio, here's how to start. Part 11. What's next? If you'd like to learn how to design a core satellite portfolio that includes structured speculative satellites, join me for a coffee with the Chief Compounder session inside the Always Be Compounding Club. Your first coffee is on me. Just use the code ONEFREECOFFEE when you sign up. The link is in the description below. We'll talk through how to identify intelligent speculative ideas and how to keep them from taking over your portfolio. So yes, speculation is risky, but not all risk is bad. When done intelligently, speculation is how innovation gets funded, how investors learn faster, and how curiosity fuels compounding. Remember, speculation becomes dangerous when it's all you do, but in small doses, inside your speculative satellite portfolio, it can make you smarter, sharper, and more engaged. Because the goal isn't to avoid all risk, it's to manage it wisely while you compound your money. Remember, the key to building wealth is to always be compounding. Thanks for watching. See you in the next video. Take care.